as always, just want to shoot you a quick video, another in the series. And yeah, today you're looking at the two versions of me. And yeah, I actually look quite similar to my younger self, but hey, what you see, that person on the left side, that's me somewhere in 2019, so roughly 6 years ago, right? And back then I had less than, I might have like a 20, 30,000 to my name, right? So here you can actually see me catering on a wedding. So, back then I was still studying in my final year of university, work in a restaurant, crazy hours, like I had to do something, right? I was literally every day I was just, you know, at school from like, morning until like 4 p.m., let's say, roughly, most days. And then I usually go to restaurant at like 5, 6 in the evening, for like the evening rush. And yeah, started helping there, in the kitchen. And stayed most of the days, somewhere close to midnight and just went straight home, sleep and next day again, right? And then it was tough, like, when you're a student, especially in a new country, as was my case, moved abroad, like you're kind of in a bad situation, right? Like you have to, well, either someone needs to support you, your parents if you're lucky enough, or you just have to work your ass off, right? But you're young, you have all of the energy, like you can do it, right? But the point is also, of course, in life to evolve, right? And don't stay, someone like this. And sure, like back then I didn't know much, right? And I didn't know much about investing either. I knew something, like back then I was already investing. Once again, I had my maybe like 30,000 in stocks. It was 2019, so back then I was buying, lots of Tesla, which Tesla did 20x since then. And many other companies, I had some Apple back in the days, a couple of the, big names, and my portfolio evolved a lot over the years. But once again, like the progress, right? So the point was that every subsequent year from this one, get better, grow portfolio, invest more, be able to invest more, right? And bigger gains. Because at the end of the day, right, when we do what's required, we can take care of ourselves, we can take care of our, loved ones, we can take care, we can be that positive beacon, right, and inspire other people to work on themselves. And that brings us to, of course, hey, keep leveling up, right? And now, hey, 7 figures, what changes, right? So once again, like, the game changes slightly, but we still have to do the basics, do them right. So let's continue in the series, and lesson number 4, 99 no's and 1 hell yes. Because if you want to win this game, you need to expose yourself to plenty of ideas. You need to keep your radar on, scanning the market, reading, observing, connecting dots. The more ideas you encounter, the more likely you are to stumble upon the few that actually matter. But you don't chase every idea, right? You probably hear plenty of people talking about many stocks, on YouTube and Twitter and, maybe some friends and then CNBC, and, there's always someone coming, some CEO basically pitching their own company because that's their job, right? Like they're pitching their company to investors at the end of the day, right? And it's up to you to be, like, hey, what's going on over there? Okay, you're saying this, but, how close are we to the truth, right? So you don't want to also waste energy on mediocre opportunities. You need to think of it like swimming upstream in a river. The current is filled with noise, right? So there are all these ideas that are kind of coming your way if you're observant, right? Speculations, headlines, hot stock tips, distraction disguises opportunities. And there's always like some theme, something that's like hot, like, quantum stocks here, and back then it was, wheat stocks, and back then it was like EV stocks, right? There's always like a big topic, this is going to be the next big thing. And sure, there are some of the very good ideas, right? Like Tesla back in the days, right? That was a great idea back in 2019. But basically every other EV stock, oh god damn it, that wasn't good. That wasn't good, right? If you look at some NEO or things like that. So most ideas are junk. And some are outright dangerous, right? So if you just float and let the current pull you, you'll be swept away by mediocrity and confusion. So your job is to swim against the current, eyes open, deliberate, focused. Ideas will float past you every single day. And most of them you have to let go, right? You have to build the muscle to ignore, discard, dodge 99% of them without hesitation. Because at this level, it's not about being busy. It's about being precise, right? You don't waste your time chasing small wins. You don't trade meaningful progress for meaningless activity. Your attention is finite, and it should be reserved for the big numbers, the ones that can actually bend the curve. Because one great 300k position can move your portfolio. 10 cute 5k trades won't. When you have 7 figures invested, why do you throw 5k into something, 10k into something? And this is why most people underperform, right? They think the goal is to do more. There is this stock here and there's this stock, and we end up like kid in a candy store and like get everything. No, the goal is to filter hard, to say no 99 times out of 100, and when that one hell yes moment shows up, strike hard with conviction. That's how serious wealth is built. And I know I'm repeating lots of these topics, but they're important, right? So cash buys courage. David Tepper didn't get rich by chasing hype. He got rich by waiting. In March 2009, while the world was frozen, he bought bank stocks, Citi, Bank of America, and others at prices that look suicidal. They went on to 5x, 10x or more. Why could he do that? Because he had the cash. Same story with Seth Klarman. His firm, Baupost, is famous for holding 20 to 30% of its portfolio in cash, sometimes for years. Critics call it lazy. Klarman calls it an option with no expiration date. When you're managing 7-figure portfolio, cash isn't drag, it's a dry powder. It gives you the ability to buy when others are selling, to act when others are scared, and to make moves that actually move the needle. The market always offers moments of irrational pricing, but you only get to take advantage if you're ready, both financially and mentally. So we hold cash not out of fear, but preparation. Because in the storm, conviction is priceless and cash is what lets you use it. Right? Lesson number 5, non-negotiables. And I want to be clear on what level are we, talking about here, right? Because, and I hope this is helpful for everyone. But at this level, when we have 7-figure portfolio, what I'm going to go over now, these are non-negotiables, right? Like, even if, and I talk with plenty of people who are investing, and there are sometimes those kind of people, and you probably know them, that, they might have, getting to that 6 figures or already maybe 6 figures, right? Because, and 6 figures, right? But they still don't know what the price to earnings multiple is. I'm like, that's not good, right? Because at this stage, and like basically everything that I'm going to read you should be non-negotiables already from like 6 figures up. Like if you have 6 figures in the market, in your own hands, not talking, index fund, things like that. But if you have 6 figures in individual stocks, like you have to know all of these, right? Because at this stage, you're no longer learning how to start. You're not here to figure out what the P ratio is or how to structure a portfolio. You've made it far enough that you already know the game and keep playing at this level to constantly aim for 20% annual returns year in and year out. There are principles that are no longer optional. These are non-negotiables. The basic operating system every serious long-term investor must have embedded in their decision making. If you don't have these under control, you're not playing the same game. You're gambling, right? Portfolio management, right? We don't just buy random stocks or, kind of like cake with all of the flavors. No, it's a portfolio, right? So manage portfolio like an operator. Optimal number of companies in your portfolio, right? This must be conscious decision. Of course, the exact number, the details might vary a little bit individual by individual. Sure, I have some rules of thumb, I have guidelines, but this needs to be conscious decision. Sector diversification, right? If I have, let's say I can have relatively fewer number of companies, but are they at least diversified across the sector? Again, is it a conscious decision, right? Because also sectors are moving differently. This needs to be thought through. Cash position management, previous point, right? Hey, Do we have some cash? Do we have some framework how to move with the cash position with the market? I do. Do you? Hedging strategy. If and when, right? Again, conscious decision. Are we hedging? How are we hedging, right? Hedging is just the overall bigger framework, right? How to protect the portfolio from downturn. That can be achieved by different means. How? You have to know. Proper position sizing, right? So, proper allocation. When we are building position, how much money we can put in. If that position grows, are we, trimming it? Are we letting it in? Are we basically basing it on how much money we've put in? Or are we basically, making the decision based on that actual portfolio position, right? Scaling in and out without emotional decisions. Scaling plan, right? So, hey, from 0 to 6 figures is different from 6 to 7 figures. And 7 figures to 8 figures, also different, right? Slightly different nuances. We have to know. Valuations. B. You can't pay whatever price. You need to know how to value what you buy, right? That is also slightly different depending on what kind of company, what kind of sectors, right? So how to value stocks, how to value dividend paying companies, how to, safety of dividends, right? How to value growth companies. That's harder, that's nuance, right? Valuing value stock, intermediate level. Valuing growth stock, that's hard. Which financial ratios to prioritize? Sure, there are some of the, again, basics, but also might sometimes differ by sector, right? If you're buying a bank, many people have SoFi, price to earnings multiple, sure, nice, but not ideal, right? Price to earnings multiple is, for example, usually for profitable companies, stable, profitable companies, right? So when to use price to earnings, when to use price to sell, when to use price to free cash flow, right? These are important differences. Revenue and net income modeling, right? Be able to extrapolate and forecast the future with a certain degree of certainty. Running realistic projections for a company. Performance, stock price ranges. Comparative valuations, right? Do we have a couple of companies in the same industry? Can we compare them across each other? How to value cyclical companies? Tricky. I don't like cyclical companies. But again, it's a conscious decision, right? I'm kind of trying to avoid them. But it is conscious decision. And if you want to go into cyclical companies, you have to know they have certain specifics. Valuation of growth companies in bull and bear cases, right? So then also being able to do like a bull case, bear case, base case, everything. C, qualitative metrics. You must understand the business, right? SWOT analyze it, mode analysis, management evaluation and conference call, right? Let's say when you're investing in a company, are you going through the management team? Are you looking at their previous employment? I love doing that. Look at their LinkedIn, look at their previous, kind of situation. Are they just kind of a professional manager, just some kind of bureaucrat, or are they actually, founder-led company, right? Those are important differences. Asset-light versus asset-heavy business model. Big difference, right? Like people sometimes try to, do some blanket slate frameworks. Big difference if, like that's why so many people missed Amazon, right? It's a asset heavy business, right? They are putting lots of their cash flow into like basically heavy infrastructure, right? Like you cannot compare it to, let's say, Google and Microsoft. That's why many people missed it. Industry dynamics, Porter's 5 forces, again, more kind of qualitative frameworks. D, quantitative metrics. Numbers do matter. Core financial ratios, right? Price to earnings, price to sale, advance ratio, price to free cash flow, return on equity, price to earnings growth, share buybacks versus dilution, total addressable market, right? All of these. Also the financials, we have to speak that language of business. How to understand income statement, revenue, margins, profits, potential red flags, balance sheet, assets, liabilities, leverage, health of the company, cash flow statement, where the money is really going. Key takeaways from annual and quarterly reports. Risk segment in 10K, 10Q. Most important part in my opinion. Macroeconomic context. We cannot control it, but we can understand it, right? Understand at least broadly market cycles and how they affect returns. Macro forces, interest rates, inflation, Federal Reserve, corporate tax landscape, recessions and how to behave during them. And finally, mindset and philosophy. Power of compounding, focusing on value creation, not speculation, and long-term investing. It's a long list, right? But when you actually look at this guy over here, right? This guy over here, like this guy over here, back in 2019, that was the guy who was going through all of these, right? Because sure, I was in my first couple of years investing. This was 2019. I started investing late 2017. So this was only my second year of investing, basically, second full year of investing. So back then, I could afford to still say, hey, I'm still learning all of these things. That's fine. It was just my second year. But roughly by, let's say, year 3, year 4, right? Or, whatever metrics you want, right? But either when you have 6 figures or when you are, let's say, in those third, fourth year of investing, like you have to know all of this, like all of this. And if not, damn it. Whew. Lesson 6, owning the future. I love the future. All my money's in it. Because, and this sounds funny, but you have to understand where your portfolio is headed, right? Because let's say, this portfolio here that I have currently, roughly around 2 million mark, right? That's in this present moment. But 5 years from now, where can this portfolio be? And I should have a relatively good understanding, right? Because for all of those companies here, we should roughly understand, hey, if I'm holding this company, AMD at, let's say, around 100, or 100 was my cost basis, right? Now it's, well, this is a little bit older screenshot. But okay, if I have this position in AMD, roughly 111,000, how big is this position going to be in 3-5 years? Roughly, again, like I'm never going to be precise, but I should roughly understand what's that, reasonable range of probabilities, right? So this here is already seedling of something much, much larger, right? So wherever we are on our journey, we are actually controlling, and our decision have much bigger magnitude, right? Because let's say if someone has first 6 figures, just crossed that 100K. Well, we have to understand that first 6 figures, that 100K there, that's already the seedling of 300K, 500K, a million, right? Because in theory, portfolio of 100K, even without other contributions, competent investor should be able to set it up so well that 100K basically grows into a million in roughly a decade, let's say, more or less, right? So those decisions that person is making here at 100K are actually decisions with the order of magnitude more important, right? Those are already 7 figures decision, right? Because if you're managing portfolio that has 10,000, you have to act like it's a 100K portfolio, and a 100K portfolio you have to act like it's a million portfolio, and if you have a million portfolio you have to act like it's already 10 million, because that's the only way how to get there. And so once you've crossed into that 7-figure territory, it's not enough to just be in megatrend. You need to own the companies that define it. Every decade has themes. Only a few companies actually monetize them. AI is in a mode. Later is climate, biotech, digital transformation. What matters is who's building the value stack, who's extracting the value, who can't be replaced. Owning the right name inside a super trend creates exponential upside. Owning the wrong one makes you a backholder with good taste. You're not just predicting the future, we are voting for it. When you have 7 figures in the market, capital becomes tool of influence. Every dollar you deploy is a bet on how the world will look in 10 to 20 years from now. That's both a responsibility and an advantage. Because you get to say, I believe this company will be a dominant force. I believe their vision, execution, and culture. I want to benefit from their growth, and I want to be part of that arc they shape. This is intentional capitalism, and it separates you from the tourist. You don't need to own every player in a trend. You need to identify the kingmaker, the company with structural advantages, not just marketing hype, the team that executes relentlessly, not just tweets well, the balance sheet that outlaws hype cycles. Because in a world of exponential change, the winners take it all, and it is your job to find them early enough to matter, but late enough to be right. And so in seven figures, moats aren't optional. They're the only thing. Every dollar needs to be locked behind a moat. Not a cute narrative, not a buzzword. Real, defensible economic fortress. We are looking for a business that cannot be easily copied, are deeply embedded in the supply chains or consumer habits, have a pricing power, distribution power, or network effects, and preferably all of the above. Whether the advantage is IP, scale, brand, switching cost, founder's obsession, we are not buying companies that might win. We're buying the ones that the rest are trying to survive next to. And you have to have that, you have to be strict with portfolio, right? It's your money at the end of the day, right? So give it meaning. Appreciate you. Happy weekend.